Now, when you talk to people and say that, what is it then, we all understand importance, what is it that is holding back the growth of this market? We have the long list of items that were mentioned this morning. But one thing that instinctively comes to people's minds, when you talk to people, is say, there is no retail participation or appetite for debt. I would like to examine this hypothesis by presenting certain data in front of you. Fixed deposits in banks is a very basic form of debt, assured return, a certain amount of liquidity in the form of the fact that you can break it, a certain amount of return that's higher than having a savings account or a current account. So it has security, it has liquidity, and it has returns. Fixed deposits is well understood by all. But we all think that debt is only in the form of fixed deposit that we invest. But all of us, in our own silent way, invest in a provident fund, pension, which is just getting deducted from our salary, is getting invested in the form of debt. And that's also our own individual participation in the debt market, which we don't very cognizantly know. Now, you might then argue, legitimately, that these are forced savings, forced investments into debt, both corporate as well as government, where is voluntary contribution or voluntary participation in the debt market. There is also voluntary participation. I'll share you some data about the contribution of the mutual fund industry. The total mutual fund market in India is 7 lakh crores, out of which 2 lakh crores, as all of us are aware, is in the equity market. 2.5 lakh crores is in liquid funds, which is largely investments in call money or certificates of deposits or commercial paper. And after these two, there is 3.5 lakh crores in debt funds. And these debt funds in the form of government debt, corporate debt, 3.5 lakh crores is from investors like you and me. Now, therefore, there is the appetite, the willingness, and the need of investors to participate in debt, which is in an indirect way, not directly like fixed deposit, but in an indirect way is coming from all of us in the debt market. It's not only mutual funds. The insurance industry, which is largely, let me say, 95% retail, except a small group business that the insurance business does, about 60,000 crores of new business premium, about 200,000 crores of total premium received every year. A good portion of this money, in fact 25% of government debt is subscribed by insurance companies, largely contributed by LIC. All that is retail money like you and me. Therefore, this fundamental assumption that we instinctively share, which when we talk to 8 out of 10 people to say that we retail customers investors don't invest in debt, it's true to the extent it's not coming directly, like you and me haven't gone and subscribed to a government bond, which is true, but in an indirect way through the form of insurance, the form of mutual funds, and the form of debt funds of 3.5 lakh crores is definitely coming. In fact, I do defer to what Mr. Rathi pointed out in terms of corporate debt, direct issuances from companies. I do agree that fixed deposits have a larger number of takers, but remember that when SBI came out with the Tier 2 bonds, they got a 15x subscription. When a Tata Motors comes out, when a Shriram Transport comes out, when one of these good companies comes out with fixed deposits or NCDs, even public, they do get subscribed. So it's not as widespread as Dr. Rathi pointed out, but fact is that when there is a good name, there is participation, and else, except the part of the good name, you have contribution through other means. The short point therefore is that as long as there is safety, there is liquidity, and there is return, in some way this will all come through. Now, when we talk of safety, of course, you could do a lot of improvements to the safety picture. Dr. Gokan pointed out that can credit enhancement be done by banks? In a way, it is nothing but the CDO, CLN structure of the international banking system. We're figuring out whether that can be applied to the corporate debt market and can it be given a AAA status and thereon. Number two, as far as liquidity is concerned, we all know that market making is a real big issue in India, and therefore today we will talk about how to do this market making. And certainly the providing a repo facility on corporate bonds is a really big thing. I think it was started somewhere in April of 2010, but it hasn't got the traction because of certain settlement issues. But short point is that providing repo rates in corporate debt is a real big thing, because suddenly market making becomes real, suddenly liquidity comes in, and one of the key issues that are plaguing the Indian corporate bond market is not safety as much. It's not returns. Returns are actually quite good. It's even better than fixed deposits. It's liquidity. How do you get out when you want to get out, right? And that can be provided by market rating. And of course, as far as returns are concerned, you could do many things like tax benefits to infrastructure. I saw the L&T infrastructure fund that came out recently, where they talked about where they got some tax benefits, or stamp duty, or so on. But in the end, of course, apart from these three factors, the safety and the other things we talked about, it is also being able to provide a platform. Of course, the BSE has this platform to trade debt, but I think it will need a lot more participation, and will need a lot more liquidity, so to say, to make it all, bring it all alive. In the end, therefore, I just say that there is an inherent need which can be explored. There is an appetite, there is a willingness for the retail consumer to come into corporate debt. It is our way of tapping it, which we will have to explore in the course of the day. And according to me, I would leave this to the chairman of how to explore that as one of the key issues that we need to talk about today. In the end, I would therefore say that when we saw the numbers this morning, Singapore having 40% of 40%, the corporate debt market being 40% of the GDP, in Hong Kong 40%, Malaysia 40%, Korea 60%, India 8%. So when we look at the last 3 years, of course we see an increasing trend, but of course when we compare ourselves not with the performance of the last 3 years, but to the potential of what is the space available to us, and that amount of debt powering us towards the growth of the 2020, we all know about. We just know the amount of work that we have in front of us. But it can be safely summarized that there is a certain appetite for such participation. It is for us to be able to bring it to life. Thank you, ladies and gentlemen.
Thank you. Thank you, Mr. Vaidyanathan. And thanks for also mentioning about L&T. But just I want to make a small comment on this. The issue which you mentioned recently was that tax-free bond issue. That's a very difficult instrument to sell, because the limit is only 20,000 rupees, and the participants will have to, those who want to invest will only invest 20,000 rupees. However, what needs to be mentioned, and that's what I want to correct, you talked about Shriram Transport, you talked about Tata and all. L&T Finance did come out with a bond issue last year, and that was a tremendous success. And that issuance was almost of the order of 1,000 crore. And I just want to tell you that the tenor was 5 years, 7 years and 10 years. So if you market the issues well, it's fine. By the way, I do not agree that there is no appetite from retail investors. They will participate. The question is, how do we create a market? Because most of the issuers, most of the investors, they will invest and hold till maturity. Then in that case, and same is the case with institutional investors. They participate in these issuances and hold till maturity, which if you look at the volume today in the secondary market, it is pretty low. And if we really want to bring about that kind of vibrancy, price discovery, then that secondary market is extremely important. Thank you. I think we'll talk about that retail thing a little later. So we have Mr. Sugata Ghosh. He's an associate editor with the Economic Times. He has been with the Economic Times for the last 17 years. He has covered the financial markets and the infrastructure market extensively. Mr. Ghosh.
Since I'm an outsider, rank outsider, I'll take a few liberties because I don't have to deal with the regulator. I don't have to participate in the financial market.